Exchange traded funds are a very good way for people to have exposure to the markets who are maybe pensioners, approaching pensionable age, maybe even in their 40s and 50s, but still want some of the upside return without the downside volatility. And the reason exchange traded funds can work out very well for them is, first of all, they're easy to put into SIPs and ISAs because they're exchange traded. In other words, they trade on a stock market like any other stock. So you can put them in your SIP, ISA, or wherever you are in the world, whether it's in the US or the UK. The other thing is because they're a tracker, usually without an active fund manager, so they're just tracking a basket of other stocks. So a technology ETF would track, say, a basket of stocks including Microsoft, Apple, Amazon, for instance. The cost can be quite low. The other benefit of them is because they're a basket of stocks and not just one stock, the downside volatility can be quite limited. Now remember, the things which spook you or cause you emotional distress when you're investing are how much a security can fall, how quickly it can fall, and how long it takes to recover. Okay, those three things are what cause panic and, as I say, emotional distress. What limits that distress is when there is an instance of a basket of stocks, because some will fall, some will rise, counter each other out. That natural diversification to some extent, even when they're in the same theme, like technology, can be quite useful for those who don't want to have the wild swings. Yet, because you can get the same data on them as you can on a stock, you can project forward, which is a big assumption because the past doesn't guarantee the future, but you can project forward and see if they would deliver your target return. For me, it's 40% over 12 months. If it doesn't give me that kind of a target, and if the drawdown, and here's the numbers, the drawdown is more than 20%, and it takes more than 3 months to recover, then I'm not interested. So I want 2-to-1 reward to risk ratio. The other great thing about exchange traded funds, I've written about this in my Financial Times columns, in my books, is, of course, you can easily research the information and see what's in them. Just go to Google, whatever the exchange traded fund is you're interested in, it might be an iShares technology one, you can look into them and then simply see what their holdings are. In fact, for fun, I looked at a recent one, a vegan, can you believe it, a vegan exchange traded fund. Exchange traded funds tend to be based on geography theme, like vegan or tech or quantum computing. And this one, would you believe, had Broadcom in it, Microsoft, Tesla. What the heck's got that to do with veganism? So the labels don't necessarily match what it is they do. Anyway, exchange traded funds, I think they're often overlooked. As part of my Great Investments program, I make sure my clients have the data on 7,000 exchange traded funds, and then we filter that data to look at the ones which are generating high average returns, very low downside volatility, projected to go 40% forward without more than a 20% dip, so that the clients can see and globally be diversified and can see the whole gamut of investment opportunities open to them. So we do all the hard work for them. Anyway, consider exchange traded funds. As I think I've not flown the flag for them as much as I might have done in the past. So I'll talk a lot more about them. Do like and follow for more.